Most trading accounts do not explode in one dramatic moment. They leak. A little too much risk here, one impulsive entry there, and a few ignored rules when nobody is watching. Each mistake looks harmless by itself. Together, they quietly drain confidence and capital until the trader decides the market is rigged. In this video, we will expose 7 mistakes that destroy accounts, explain why they feel so tempting, and build a simple repair system you can use before your next trade. The goal is not to become perfect. The goal is to make your mistakes small enough that you survive them. Mistake number 1 is risking too much on a single idea. When the position is oversized, the chart stops being information and becomes a threat. Every tick feels personal. You move the stop, take profits too early, or stare at the screen until your judgment disappears. Professional risk begins with a boring question. If this trade is wrong, how much am I willing to lose? Choose that amount before choosing the share size. For many traders, 0.5% or 1% of the account is plenty. A good trade should matter, but it should never have the power to ruin your week. Mistake number 2 is entering without knowing what would prove the idea wrong. A stop is not a random number placed where the loss feels painful. It belongs beyond the price level that invalidates the trade. If you buy because support should hold, the thesis changes when support clearly fails. Without that line, hope becomes the exit strategy. Before entering, point to the chart and complete this sentence. I am wrong if price does this. If you cannot answer in one clear sentence, you do not have a defined trade. You have a guess wearing a very expensive costume. Mistake number 3 is adding to a losing position simply because it is cheaper. Lower price does not automatically mean better value. Sometimes it means the market is showing you new information. Adding can be valid when it was planned in advance. The total risk remains fixed, and the original thesis is still intact. But emotional averaging is different. It increases risk because the trader wants relief from being wrong. That turns one manageable loss into a rescue mission. Never add, because you need the market to forgive you. Add only when the action, location, and total risk were written down before the first entry. Mistake number 4 is chasing a move after the easy entry is gone. A giant green candle creates urgency. It makes waiting feel like failure, so traders buy far from support with a terrible risk-to-reward ratio. Then normal pullback feels like a disaster. Missing a move costs nothing. Chasing it can cost real money. Create a maximum distance from your planned entry. If price runs beyond it, the trade is over for you, even if it keeps climbing. There will always be another setup. The market sells unlimited tickets, but impatience keeps buying the most expensive seat. Mistake number 5 is overtrading. More decisions do not automatically create more opportunity. After several hours, attention fades, standards loosen, and mediocre setups begin to look exceptional. Some traders also confuse activity with progress. They feel productive because they are clicking when they're actually paying spreads and commissions to avoid boredom. Set a maximum number of trades per session and define the conditions that permit another attempt. When the limit is reached, stop. Your edge needs selectivity. A hunter who fires at every sound does not become more skilled. They simply run out of ammunition. Mistake number 6 is strategy hopping. A method loses twice, so the trader abandons it and copies something new. Then the new method hits a normal losing streak, and the cycle repeats. No strategy gets enough consistent execution to produce meaningful data. Before judging a setup, define its rules and collect a real sample, perhaps 30 or 50 trades. Track win rate, average winner, average loser, and market conditions. A strategy should be changed because the evidence says it is broken, not because 2 red trades made you uncomfortable. Consistency gives you data. Data gives you the right to improve. Mistake number 7 is never reviewing what happened. Memory is a flattering editor. It remembers the brilliant winner and quietly rewrites the impulsive loss. A journal removes that illusion. Capture the setup, entry, stop, size, screenshot, emotional state, and whether you followed the plan. At the end of the week, separate strategy losses from discipline losses. Strategy losses are the price of doing business. Discipline losses are preventable leaks. Do not try to fix 10 things at once. Find a single leak costing the most money and design one rule that makes it harder to repeat. Here is the repair framework. Before the session, choose your best setup and maximum daily loss. Before each trade, write the entry, invalidation, target, and position size. During the trade, manage only according to the plan unless genuinely new information appears. After the trade, grade the process from A to F without using profit as the grade. A losing trade can earn an A if it followed every rule. A profitable impulse can earn an F. This separates skill from short-term luck. Repeat the framework long enough and good decisions stop depending on motivation. They become the default. The market does not require perfection. It requires survival. Small losses, consistent size, clear invalidation, selective entries, and honest review will not look exciting on social media. They will look incredibly exciting on an equity curve after hundreds of trades. Choose one mistake from this video and eliminate it for the next 10 sessions. Do not hunt for a secret indicator while your account is leaking through a rule you already understand. Protect the downside first. Your edge cannot compound if your capital and confidence are gone before it is time to work.